Ever wondered how to make your money work for you? With dividend investing, you can earn passive income without much effort. In this video, we'll teach you how to start your very own dividend portfolio in just 30 days or less. Dividend investing is a powerful strategy for building wealth and achieving financial independence. But what exactly is it? Simply put, dividend investing involves buying shares of companies that pay you a portion of their profits regularly. These payments, known as dividends, can be received monthly, quarterly, or annually. The beauty of dividend investing is its simplicity and potential for passive income. When you own dividend-paying stocks, you're essentially getting paid just for holding onto your shares. This income can then be reinvested to buy more stocks, creating a snowball effect that grows your wealth over time. One key concept to understand is the dividend yield. This is a percentage that shows how much a company pays in dividends each year relative to its stock price. For example, if a stock costs $100 and pays $5 in dividends annually, its yield is 5%. A higher yield means more income, but it's also important to consider the company's stability and growth potential. Diversification is another crucial aspect. By spreading your investments across different sectors and companies, you reduce risk and increase the chances of steady income. Look for companies with a strong history of paying and increasing dividends. These are often established businesses with solid financials. By understanding these basics, you'll be well on your way to building a successful dividend portfolio. Before diving into dividend investing, it's important to set clear investment goals. These goals will guide your decisions and help you stay focused on your path to financial success. So where do you start? First, think about what you want to achieve. Are you looking to generate a steady stream of income for retirement? Or maybe you want to reinvest dividends to grow your wealth over time. Knowing your ultimate goal will shape your investment strategy. Next, consider your time horizon. This is the amount of time you plan to invest before needing to access your money. If you're young and have decades until retirement, you can afford to take more risks. But if you're closer to needing your investment income, you might want to be more conservative. Risk tolerance is another key factor. Ask yourself how comfortable you are with the ups and downs of the stock market. Dividend stocks can provide steady income, but their prices can still fluctuate. Understanding your risk tolerance will help you choose the right mix of stocks. Lastly, set realistic and measurable goals. Instead of vague targets like make a lot of money, aim for specific outcomes, such as generate $500 per month in dividend income within 5 years. This clarity will keep you motivated and on track. With clear investment goals, you'll have a roadmap to guide your dividend investing journey. Now that you've set your investment goals, it's time to dive into the exciting part, researching and choosing the right dividend stocks. This step is crucial because the stocks you pick will determine the success of your portfolio. Here's a step-by-step guide to help you make informed decisions. 1. The first thing to look at when researching dividend stocks is the dividend yield. This is a percentage that shows how much a company pays out in dividends relative to its stock price. A high yield can be attractive because it means more income, but be careful. Sometimes, a very high yield can indicate that the company is in trouble and the stock price has dropped. Aim for a balanced yield, typically between 2 and 5%. 2. The dividend payout ratio shows how much of a company's earnings are being paid out as dividends. It's calculated by dividing the annual dividends per share by the earnings per share. A payout ratio below 60% is generally considered healthy. This means the company retains enough earnings to reinvest in growth while paying out a reasonable dividend. 3. Consistency and growth in dividends are signs of a strong company. Look for companies with a history of increasing their dividends year over year. This indicates that the company is performing well and is committed to returning value to shareholders. You can find this information by checking the company's dividend history over the past 5 to 10 years. 4. It's important to invest in financially healthy companies. Look at key financial metrics such as revenue growth, profit margins, and debt levels. A company with strong financials is more likely to sustain and grow its dividend payments. You can find this information in the company's annual reports or financial statements available on their website or through financial news websites. 5. Invest in companies with a stable and understandable business model. Companies that operate in essential industries, like utilities or consumer staples, often have more predictable cash flows and can maintain steady dividends even in economic downturns. Avoid companies with complex or highly cyclical business models unless you have a deep understanding of the industry. 6. Don't put all your eggs in one basket. Diversify your dividend stock portfolio across different sectors and industries. This helps spread risk and reduces the impact of poor performance from any single stock. For example, you might include dividend stocks from the tech, healthcare, and consumer goods sectors. 7. Utilize reputable financial news websites stock analysis platforms, and tools like Yahoo Finance, Morningstar, and Seeking Alpha to gather information. These resources provide in-depth analysis, news updates, and expert opinions that can help you make informed decisions. 8. If researching individual stocks seems overwhelming, consider investing in dividend-focused exchange-traded funds, or ETFs. These funds pool money from many investors to buy a diversified portfolio of dividend stocks. Dividend ETFs can provide instant diversification and are managed by professionals, which can be a good option for beginners. 9. Once you've selected your dividend stocks, it's important to regularly monitor and review your investments. Keep an eye on quarterly earnings reports, dividend announcements, and any significant changes in the company's performance or market conditions. This will help you make timely adjustments to your portfolio if needed. Dividend investing is a journey that requires continuous learning and staying informed about market trends and economic factors. Follow financial news, read books on investing, and consider joining investment forums or groups to share insights and gain knowledge from experienced investors. By following these steps, you'll be well equipped to choose the right dividend stocks for your portfolio. Now that you've researched and chosen your dividend stocks, it's time to build your portfolio. These 9 tips will guide you through the process of assembling a balanced and effective dividend portfolio that aligns with your investment goals. 1. If you're new to investing, start with a small portion of your capital. This allows you to get comfortable with the process without risking too much of your money. As you gain confidence and experience, you can gradually increase your investment. 2. Decide how much money you're going to start with. It doesn't have to be a large sum. Remember, the goal is to build your portfolio gradually. Even if you start with 100, it's a step in the right direction. The key is to be consistent with your investments over time. 3. To build a diversified portfolio, allocate your funds across multiple stocks. Avoid putting too much money into a single stock, as this increases your risk. A good rule of thumb is to have at least 10 to 15 different stocks in various sectors to spread your risk. 4. A balanced portfolio should include both high-yield dividend stocks and dividend growth-oriented stocks. High-yield stocks provide regular income, while growth stocks have the potential for capital appreciation and higher dividends in the future. This balance helps in achieving steady income and long-term growth. 5. Dollar-cost averaging involves investing a fixed amount of money at regular intervals, regardless of the stock price. This strategy helps mitigate the impact of market volatility and reduces the risk of investing a large sum at the wrong time. For example, you could invest $100 every month into your dividend portfolio. 6. Reinvesting your dividends is a powerful way to accelerate the growth of your portfolio. Instead of taking the dividend payments as cash, use them to buy more shares of the stocks in your portfolio. This creates a compounding effect, where your dividends generate more dividends, boosting your overall returns over time. 7. Periodically review your portfolio to ensure it aligns with your investment goals. Look at the performance of your stocks, the dividend yields, and any changes in the company's financial health. Be prepared to make adjustments by selling underperforming stocks and reinvesting in better opportunities. 8. Be mindful of transaction fees and taxes, as they can eat into your returns. Choose a brokerage that offers low fees and consider the tax implications of your investments. For instance, holding dividend stocks in a tax-advantaged account like an IRA can help minimize taxes on your dividend income. 9. Building a successful dividend portfolio takes time and patience. Stick to your investment plan and avoid making impulsive decisions based on short-term market fluctuations. Remember that dividend investing is a long-term strategy aimed at generating steady income and capital growth. By following these steps, you can build a well-rounded dividend portfolio that provides regular income and long-term growth. Now that you've built your portfolio, it's time to buy your first stocks. This step-by-step guide will help you navigate the process smoothly and confidently. 1. To start buying stocks, you need a brokerage account. Choose a reputable brokerage that suits your needs. Look for features like low fees, an easy-to-use platform, and good customer service. Popular options include Robinhood, Vanguard, and Charles Schwab. Sign up for an account, complete the necessary paperwork, and fund your account with the amount you've decided to invest. If you decide to use Robinhood, use the link in the description below to get one free stock when you fund your account. 2. Before buying, determine how much money you want to invest in each stock. Remember the principles of diversification and not putting all your money into one stock. Allocate your funds according to the plan you set for yourself, balancing between high-yield and dividend growth stocks. 3. Once your account is funded, it's time to place a buy order. There are different types of buy orders, but as a beginner, a market order is the simplest and most common. A market order buys the stock at the current market price. 4. After buying your stocks, monitor their performance regularly. Most brokerage platforms offer tools and alerts to help you keep track of your investments. Check the price movements, dividend announcements, and any news related to the companies you've invested in. This will help you stay informed and make better decisions in the future. 5. Periodically review your portfolio to ensure it's aligned with your investment goals. If a stock isn't performing as expected, consider whether it's time to sell and reinvest in another stock. Remember, investing is a long-term game, and patience is key. 6. As you gain experience, continue to educate yourself about investing. The more you learn, the better equipped you'll be to make informed decisions. Join online communities, follow financial news, and consider seeking advice from financial advisors if needed. The financial markets are constantly evolving, so it's important to keep learning. Congratulations on purchasing your first dividend stocks. Now that you've built your portfolio, it's crucial to monitor its performance and consider reinvesting dividends to maximize your returns over time. Regularly monitoring your portfolio is crucial to understanding its performance and ensuring it aligns with your investment goals. Most brokerage platforms provide tools to track your portfolio's performance, including gain-loss tracking, dividend income, and overall portfolio value. One significant advantage of dividend investing is the ability to reinvest dividends to compound your returns. Dividend reinvestment involves using the dividends received to purchase additional shares of the same stock or different stocks. Many brokerages offer dividend reinvestment plans, or DRIPs, which automatically reinvest dividends into more shares of the paying stock without charging you a commission. If your brokerage doesn't offer DRIPs or you prefer more control, you can manually reinvest your dividends. Simply use the cash dividends received to purchase more shares of the dividend-paying stocks in your portfolio. As your financial situation or investment goals change, you may need to adjust your portfolio. This could involve adding new dividend stocks to diversify further or taking advantage of new investment opportunities. It's also important to evaluate underperforming stocks and consider selling them to free up funds for better opportunities. Remember that dividend income is taxable. It's essential to understand the tax implications of your investments. Different types of dividends, qualified versus non-qualified, are taxed at different rates. Consult with a tax advisor to optimize your tax strategy. Now that you've learned how to research stocks for your dividend portfolio, it's important to understand why you should stop focusing on high dividend yields. This shift can significantly impact the long-term growth and stability of your portfolio. Be sure to watch the next video where we'll talk about what you should be doing instead. It's essential for building a sustainable and resilient dividend portfolio. See you there.